And now for the Center Square Daily, let's talk about how the military operations overseas could possibly be impacting you, the taxpayer, and the economy. With a conversation we'll have with Orphe Divounguy, a Ph.D. economist, and he joins us now. Orphe, thanks for taking time with us. As someone who's studied economic history, your insight on what we could have seen in the past and how it typically transmits into a broader economic picture, these types of large-scale military operations.
Yeah, hi, Greg. Thanks for having me. So I think I'm glad you mentioned the transmission channel, right? The primary economic transmission from a conflict of this scale runs through three channels: energy markets, financial conditions, and fiscal, right? The fiscal impact. And the most immediate is, of course, energy. Roughly 20 million barrels of oil and petroleum products transited the Strait of Hormuz daily before the conflict. When that choke point is disrupted, the shock is global and fast. Most economists will remind you of the crises of 1973, 1978, right? As evidence that every time, we get an oil shock, right? A spike in oil prices, we usually get a global slowdown.
When we look at the recent history here, oil spiking considerably just in the past week. That is seen in previous operations, say World War II and any kind of operation there in between.
You'd have to go back to the 70s, right, where we had a similar type of conflict. And when I say similar, it was much larger. This is still very small, and hopefully it won't last very long, right? The impact will get worse if the conflicts lasts, right? And so I think that's an important point to make. The other point to make is that there is a little bit of nuance, right? The U.S. became a net exporter of oil. And that's a positive, but that doesn't insulate consumers completely from the price spikes, right? Despite record levels of domestic fuel production, the U.S. is more exposed than ever to global fuel interruptions because a decade of infrastructure building has linked domestic supply to overseas markets, right? Oil prices are set on the global market, and nearly half of the cost of gasoline is the crude oil from which it is refined. So American producers might benefit a little bit from higher prices. Their revenues might rise, but American consumers still pay the global price at the pump. So it's really a distributional story within the U.S., right? It's not a complete shield. You're going to have some winners, but most consumers could be losers.
Now, we don't know the duration of this current operation. Congress has taken some votes, but still no declaration of war. The administration telling us it's going to be a short operation. But what are some of those headwinds that people can look for that have been seen in the past, either during or after these types of major geopolitical conflicts?
Yeah, of course. The headwinds, right? As I mentioned, the consumers in the first few weeks after the conflict began, right, the average price of gasoline in the U.S. soared, right? We saw, and it's still rising, right? Higher oil prices also feed into electricity, fertilizer, food, plastics. Broad cost of living price increase. For monetary policy, right, we watched the Fed this week, right? Instead of lowering interest rates, right, what the Fed did is it held rates steady. And the reason it did so was because, if you look at the summary of economic projections, more and more FOMC members believe that inflation could be slightly higher than they had initially anticipated, right? So slightly higher inflation, slightly lower economic growth, and the Fed is kind of stuck, right? It looks at the labor market. It's a labor market that's not producing new jobs. Labor market has essentially stalled in 2025. And yet, when you look at the inflation picture, right, inflation is not coming back down to target. That's a big problem. You probably saw the IMF managing director in the news last week talk about the fact that a prolonged conflict would be an inflationary risk to the economy, right? While at the same time lowering global economic growth, right? For low-income households right here in the United States, it's especially painful because they see a larger share of their paychecks going to necessities, pumping gas in your car to get to work, right? And that's why we should be concerned.
Orphe, we recently with the Center Square Daily looked at some of the trends from recent history when it comes to oil prices and pain at the pump, so to speak, right? We, of course, seen the increase in the gas prices most recently, some giving the reason to the conflict in Iran. But go back to 2022 when we had that 9.1% inflation for all goods in that summer. And gas prices then were, like $5 a gallon in some places of the country. What was behind that? Was that the global conflict between Ukraine and Russia?
No, I think when you look back at the conflict between Ukraine and Russia, it was some farm products, right? Some soybeans and others, right? The things that Ukraine really exported to the world. And so that wasn't really the problem. I think we went through an inflation surge because of a combination of things on the policy front, right? So we had the big fiscal stimulus that came after COVID or during COVID, where almost every household had some sort of check coming from the government, while at the same time the Fed had lowered interest rates. Completely different scenario, but the pain was very much similar, right? You felt it at the pump, you felt it at the grocery stores.
Yeah, I don't think regardless of what caused it, people still felt it.
Exactly. Now it was a bit different in the sense that at least at the time, the labor market was on fire. And so you remember, people were quitting their jobs because they could find better opportunities, right? Today, that's no longer the case. Right, the labor market has cooled significantly, and we went from what economists call the Great Resignation to the Great Stay. People are not quitting their jobs anymore because job openings are actually now below the number of job seekers, and it's become very, very difficult to get a new job or to even get a raise for those who are currently employed. Which is why I think, when you look at monetary policy, the Fed's usually very concerned about inflation expectations. If people believe prices are going to go higher and they have more bargaining power on the job, they're able to negotiate higher wages, which then creates this wage price spiral that the Fed is trying to avoid. In the current situation we're in right now, it's very unlikely we'll see a wage price spiral, because workers have less bargaining power, because there's just not enough jobs out there for everyone, and the labor market has slowed tremendously, which is another way of saying, the Fed could probably look through this current price shock to help support a very weak labor market.
Talking with Orphe Divounguy, a Ph.D. economist, to get some insight on the economic consequences and bellwethers, so to speak, when there are international conflicts, especially as people are seeing increased gas prices and some worried it's going to add to inflation. And talking about the jobs market, Orphe, an interesting kind of factor to work into all of this. But talk about some of the economic sectors that may benefit or be improved, or some kind of impact to them during these types of military conflicts.
Totally. A potential tailwind is going to be for U.S. energy producers, right? Higher global oil prices mechanically boost revenues for domestic producers. But this is essentially an income transfer from U.S. consumers to the energy sector. And so also maybe the defense sector, right? I watched the news yesterday. He talked about another $200+ billion needed for military operations, right? And so the defense sector, U.S. energy producers might gain some from the current situation, but ultimately, higher government spending with basically deficit financed spending could have potentially put pressure on prices, right? We talked about the oil price shock, but ultimately that oil price shock is already lifting interest rates higher. So that's, despite the small positive here, ultimately the conflict could be a net negative for global economic growth and even for U.S. economic growth because of the impact on interest rates, right? Interest rates are rising. The Fed, prior to 2025, the Fed was on a path of cutting interest rates. That is no longer the case. The Fed, if you look at the summary of economic projections, it signals maybe one more rate cut in 2020 and 2026. But we'll have to wait and see, especially if this conflict continues to go on.
Yeah, if it's a protracted conflict like we saw in Afghanistan and Iraq, you can definitely see some of those economic conditions down the line. Orphe, finally here, obviously when government does something, the taxpayer pays for it, right? Even if the government's paying for itself to have, vehicles with higher fuel costs, that's paid for by the taxpayers. But how are consumers, how are taxpayers impacted in different economic spectrums, right? Are those who make more money going to be feeling this versus those who don't make as much money? Talk about that a bit.
I think everybody's going to feel it. Right? It starts at the pump, right? You look at the oil shock, right? Global oil shock is causing gas prices to increase, so everyone's feeling it. But ultimately, people with lower income households are going to disproportionately be impacted, right? So, I'll take a very simple example. If you're working from home, right, you don't actually have to go to the pump every day and fill up, right, to go to work, right? And so lower income families, certain types of workers will be disproportionately affected. But ultimately, you look at interest rates and what's happening to interest rates. Mortgage rates in the housing market had dipped below 6% in February, and they've been rising since then. Right now, mortgage rates are up to roughly 6.2, according to Freddie Mac, 6.4 when you look at Mortgage News Daily. And so interest rates are going to be affected. They're moving up, not down. And so, again, that's going to affect the average households.
No question about it. Orphe, we're going to have to connect again on this issue as we see this continue and to get more of those projections and, understandings of how exactly all this is impacting the taxpayer and those in the everyday economy. Greatly appreciate you taking the time with the Center Square Daily.